It's Tuesday, July 7. Let's break down what's happening in Korea's financial sector. Right now, there's a fascinating contradiction playing out in how capital is moving. Today, we're going to connect a few seemingly disparate dots for you. Massive infrastructure loans, stubbornly stagnant bank valuations, and a sudden wave of regulatory roadblocks hitting Korea's biggest fintechs.
Yeah, it really is a complex landscape, but once you look at the underlying mechanics, there's a very clear thread connecting where the money is flowing and, exactly where it's getting trapped.
Let's start with that capital movement. So the Korea Development Bank, along with Woori and KB Kookmin Bank, they just committed 1.1 trillion won.
Wow, which is roughly 790 million US dollars.
Right, and that's to fund a new AI data center in Goyang. Now, you know how project financing works, right? Think of it like a mortgage based not on your current salary, but on the future rent of a house you haven't even built yet. Given that, why are traditional lenders suddenly going all in on tech infrastructure?
Well, the fascinating part is that they aren't viewing it as a venture risk at all. That's the paradigm shift here. Traditional banks are looking at the global explosion in AI computing demand, and, well, they're calculating that the future cash flows of a data center are practically guaranteed.
So they see it as a sure thing.
Exactly. They're treating these computing hubs like essential utilities, the railroads or power grids of the 21st century. It takes that inherent unbuilt asset risk of PF and transforms it into a highly strategic, ultra-reliable, long-term growth engine.
But I mean, here's where that forward-looking narrative hits a wall. If these banks are securing such lucrative infrastructure deals, you would expect the markets to reward them. Instead, their valuations look like they're permanently stuck in the past.
Oh, it's a massive disconnect. If you look at the major Korean financial holding companies, they're trading at an average price-to-earnings ratio of just 9.38. Compare that to Wall Street, where JPMorgan Chase is sitting at a 16.01 PER.
Wait, 16.01 versus 9.38. That is a huge gap.
It is. And it gets even worse on an individual level. KB Financial Group, which is one of the key banks backing that Goyang data center, trades at just a 7.58 PER. That severely lags behind Bank of America at 14.57 and Citigroup at 17.30.
So is this just the infamous Korea discount at play? And can the government's Value Up program actually fix it?
Well, the issue is that the market is pricing in structural governance, not just a flashy tech portfolio. Foreign capital looks at the Korean banking sector and still sees, frankly, opaque decision-making and poor shareholder returns.
Right, so they need more than just promises.
Exactly. The Value Up program is a step in the right direction, but institutional investors won't re-rate these stocks based on government initiatives alone. They want to see forced, measurable governance reform before they start valuing KB anywhere near Bank of America.
Which means traditional finance is trapped by its legacy governance, even when investing in the future. You'd assume this is where modern, agile fintechs step in and dominate the capital markets, yet they seem to be hitting a completely different wall.
Yeah, they really are. Regulators are slamming the brakes on complex fintech maneuvering right now. Take TOS, for example. They want to execute a phased listing, meaning going public in the U.S. first and then in Korea. But regulators are immediately pushing back on the sequence and timing. And at the same time, Dunamu-Naver Financial have indefinitely postponed their comprehensive stock swap deal.
Wait, I have to push back on the TOS situation for a second. Didn't Coupang do a direct U.S. listing without triggering this much regulatory alarm? Why is COS's phased approach facing such a different response?
Well, it comes down to the mechanics of that phased approach. Coupang did a direct single market listing, clean and straightforward. TOS wants to sequence a dual market entry, which is entirely different.
I see, because of the two different markets.
Right. For regulators, a sequenced listing creates a nightmare scenario regarding jurisdictional oversight and pricing discrepancies. If a company lists in New York first, how does the Korean regulator protect domestic retail investors from wild price volatility when it finally lists in Seoul 6 months later?
That makes a lot of sense, yeah.
Add in the stalled Dunamu-Naver swap, and the message is clear. Regulators are treating any complex, cross-border, or crypto-adjacent restructuring as inherently dangerous right now.
Which brings us to the core of what we're looking at today.
The 1.1 trillion won commitment to the Goyang data center proves domestic banks are securing their foothold in the AI boom via aggressive project financing. However, TOS's IPO struggles and the stalled Dunamu-Naver swap show that tech and crypto-adjacent financial maneuvers still face severe regulatory bottlenecks. Ultimately, Until the value-up agenda forces real governance reform, the glaring valuation gap between Korean lenders and Wall Street giants like JPMorgan will persist.
If the regulatory friction at home remains high, will the next generation of Korean fintechs abandon local markets entirely for Wall Street? That's today's AI PRISM Finance Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.